Celsius is a company that has been talked about a lot lately. They make an energy drink that has gained a lot of popularity, with their revenue growing from $75 million 5 years ago to $1.49 billion currently. However, the stock is down 51% in the past 6 months because sales growth has decreased. In Q4 2021, they grew by 192% and last quarter by 23%. Their fundamentals are very good as they have an amazing balance sheet with only $1.7 million in debt and they have $900 million in cash. Their free cash flow and net income have also grown massively, with net income being negative 3 years ago and being $290 million currently, and free cash flow from being negative 4 years ago and growing to $245 million currently. Analysts are expecting them to keep growing both revenue and earnings per share, reaching $2 billion in revenue and $1.45 per share in 3 years. They also have a very good return on invested capital of 18% and return on equity of 26%. And their margins are very good, with gross margin being 50%, profit margin 19%, and free cash flow margin 16%. They are also selling for a PE of 33 and price to free cash flow of 30, which might not be expensive for a company that is growing so fast. However, in order to take a deeper look at the valuation, I used my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value according to my discounted cash flow and net income for Celsius is between $16 per share and $96. Moreover, this means that if the low assumptions occur, you're going to make a negative 2% annual return on your money, middle positive 14%, and high 30%. There is a wide range because there is a lot of unknown about the future of this company. But I believe my assumptions are reasonable as I have the company growing 10% annually for the next 7 years on my low assumptions, 18% on the middle, and 26% on my high, with an average profit margin and free cash flow margin of 12%, 16%, and 20%, which is around what they have been doing. I assigned a 15, 20, and 25 p.m. price to free cash flow at the end of the 7 years and left the share outstanding change at 0%. In conclusion, the valuation looks good but not a screaming deal. This is a company that still has a lot of room for improvement as their market cap is only $7 billion. For reference, Monster Energy has a market cap of $52 billion, which is roughly 7.5 times more. By the way, Monster is one of the best performer stocks of all time. Moreover, the energy drink market is expected to grow at a compounded annual growth rate of 8% over the next 10 years, and they are expanding internationally, which could be a huge opportunity. They are currently the number 3 energy drink in the US behind Red Bull and Monster. However, they have been losing some market share lately to both, and Pepsi recently reduced inventory on a deal they had. In conclusion, I believe this company could turn out to be a very good investment, but it's not a screaming deal in my opinion, and there is a lot of unknown about the future of the company, as it depends heavily on consumer taste. I hope you found this video valuable. Let me know what you think about this company in the comments, and I'll see you in the next one.